Hey everyone, it's Coram and Harold Morris here with your option of the day. And we're going to be talking about a bearish trade idea in e-commerce giant Amazon, as a lot of the mega cap tech stocks are coming under pressure, but especially Amazon, Harold.
Yes, yes. So Amazon, as you can see on the chart, uh, it did it did it got up to the 200 day, but then it started to sell off. Found a little bit of support at the 50-day. It's been trying to break up above the 50-day the last couple of days, but it looks like it's failing. So that's the reason behind this bear call spread. We're looking for a move to the downside.
Exactly. Yeah. So with that bearish outlook here, clearly the chart coming under pressure, a lot of technical damage here. And even from a fundamental perspective, we're seeing Amazon struggling with big earnings declines, revenue in the most recent quarter, not even in the double digits. So this is not a company or a stock in the growth mode it once was. So to take advantage of this weakness, Harold, now let's go on over to the Thinkorswim platform and please walk us through setting up this trade, starting with what expiration we would be looking at.
Okay, we're going to go to the April 21 expiration. And one of the things I like as far as stocks, I like to see a lot of expiration dates like we see here, but we're going to go out to the April expiration. That's 50 days out. So I'm just going to click on that. And again, we've got calls on this side, puts on this side, but we're going to do a bear call spread. So again, we're looking for a move to the downside. So um, I'm going to start here with the 95 strike. So I'm going to sell the 95. So you can see my mouse here. I just click on sell and let me raise that up. And I'm going to go $5 wide to the next strike down. I'm going to buy the 100 strike for protection. So as you can see here, again, selling the 95 strike, buying the 100 strike, that's going to give us a credit of 153. I want to lower that to 152 because it matches the math that I've got set up on the on the notes here. We'll get to that in a second here, but let's take a look at uh, uh, what's our break even and our potential profit here and max
Great.
loss here. So I'm going to click on confirm and send. And as you can see here, our break even is at $96. So I like that. You know, the stock is trading at $90, roughly $90 now. So even if it goes up a little bit, trade works against us. It's not going to impact us very negatively. So break even is nice. There's our max loss, and of course our max gain is the credit received. Now let's take a look now at, okay, well, how many contracts can I buy given
Right.
that, okay, I'm going to use $2,500 of my capital. So how many contracts should I buy? So let's take a look at that there. So we're going to go over here on the left side. I got some notes here. So the way we calculate that is we just take the width of the spread. So we're looking at the probability of success. Probability of success, the definition is the trade making 1 penny or more. So it could just make 1 penny. Hopefully it makes a lot more. But probability of success, you just take the width of the spread. We know it's $5 wide. We take the credit, which is 152,
Mm-hmm.
as you can see here. And then this is what we have at risk, $3.48. All
Right.
right. To determine what the probability of success is as far as percentages, what we do is we take the credit, or excuse me, the actual risk divided by the risk width of the spread and multiply by 100. It gives us 69.6% uh, probability of success. I like to get around 70 and higher. So that's the ideal situation. Now again, so we're going to put $2,500 of our monies to work.
Mm-hmm.
How many contracts am I going to buy? So I'm going to take my capital, $2,500, divided by my actual risk, and that gives us 7.18. So we're going to be buying 7 contracts here. So let's adjust our number of contracts here. I'll go to 7, and let's take a look at the numbers again. First thing I like to look at, you see that right here. We're not quite at $2,500, but it's close. If you wanted to put a little bit more at risk, obviously you would just add more contracts. But uh, that's how much capital we're going to put in the risk, and again our break even and our max profit and the max loss here. So hopefully this trade will work out. We got close to a 70% chance of success. And we'll just have to wait and see what happens with this trade here.
All right, Harold. Well, thank you so much for walking us through that trade. We talked about the outlook, what the chart is doing, and what expiration we're looking for, the strikes, where our break even is. So there's just a little bit of math and planning that goes into this. But when you are doing these spread trades, it's a really great way to manage that risk and make a directional bet while being able to profit up front with the credit that you're collecting.
Correct, correct. So managing your risk is always the number one thing you want to do when it comes to trading.
Absolutely. Well said. All right. Well, that is it for today's option of the day. And make sure you check out IBD's new Options Trader app in the Apple App Store. You can download that today for more option trade ideas, education, and more. So you can download that from the Apple App Store today. Check it out. All right, everyone. That is it for today. We'll see you back here next week. Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.